Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we going to talk about? Well, I'm going to continue my series on Jesse Livermore. We're up to part 10 on that. I have a lot of methodology and action to follow up on. I'm going to go through that fairly quickly since we did talk about a lot of these things in previous shows, in recent shows that is. We have a mystery chart follow-up. We have 2 new mystery charts. I want to follow up on the next guy is going to look like a genius, and so far, knock on wood, I've looked pretty good if I am the next guy, and that'll make sense in just 1 second. Housekeeping, I do take requests. You can send them to DaveLandry.com/contact. If you go there, you can get my contact information. If you need to reach me on Twitter, it's at TFollowingMoron. My YouTube is youtube.com/DaveLandry or at DaveLandry if you're already there. Every week I do a webinar, a live webinar. You can come live and ask questions. We'd love to have you there. DaveLandry.com/webinar. If you want the slides from this presentation and all the other presentations combined, you can go to DaveLandry.com/stockcharts. All right, let's talk about the mystery charts and the methodology in action. As I said last week, on May 3rd, I received an email from someone, and they said they were to seek out somebody else. I guess I bored them to death by telling them to sit in their hands and don't do anything and just every now and then show a stock. And I said, look, we've been through these choppy times here. Why don't you just hang out a little bit longer? Because the next guy is going to look like a genius if he's a trend follower because the markets are due to trend. So let's follow up on that. So there's the current portfolio, open profits of 9044. I took that snapshot a few minutes ago. Now, when we started this, when I received the email, the open portfolio was minus $233. And then as you can see below, based on the snapshot, we're up to $9,044. We also had a $3,500 trade in between. Now, this is based on a hypothetical 100K account. But I do take these actual trades, and I also take them in a model account so that I can show the actual trade. So that's a $12,777 swing. And if you just look at the net move, it's $12,000 and a half. So it's been a pretty good run over the last couple of months or so. And that's after waiting for a long time. And that's one of the reoccurring themes you're going to find from Livermore is being patient. And I'm going to beat the dead horse on that in a few minutes. Here's a mystery chart follow-up. This is SIM. Remember, we did take this trade back here, and this was a $3,500 trade right after May 3rd. We were talking about that. And then we got back in it recently based on a Landry Light pullback. Landry Light pullback is when you have 20 or more days of Landry Light above the EMA, and ideally the instrument is accelerating and persistent and trades cleanly and has wide range bars in the direction of trend and all those other great things I talk about, which I call trend qualifiers in it. You don't just want to trade this pattern mechanically. You want to make sure the stock has a few things going for it. Go in and watch a presentation from a couple of weeks ago where I talked about this setup back here and I described why I liked it so much. All those things I just talked about were in the setup. Now, again, this is a Landry Light pullback. Entry was there, stop was here, and the IPT is right here. It came fairly close this morning. I actually went ahead and locked and loaded on half of my shares. If you're newer to the methodology, then by all means, follow things mechanically and go ahead and make sure that IPT is officially hit. In this case, I felt like it was close enough, and this one could be really choppy at times. Although it does move, it's very volatile. And sometimes I think if it gets fairly close to an IPT, it could be a gift horse. All right, here's our first mystery chart this week. Now, it's a little unorthodox. Usually I don't trade stocks that have this many days in the pullback. But with IPOs, I look at the first pullback or first deep retracement, if you want to call it that, as a little bit more of a big picture pattern. Now, as I said quite a bit before, IPOs, when they start making new closing highs, can do really well. But this stock being a little higher priced, I didn't play this first buy at B, which would have triggered way back here. Anyway, first deep retracement is a pattern I like quite a bit in IPOs. It's a secondary type of setup. A primary or pioneer type of setup would be looking to get in at the buy at B pattern. If you go in and watch last week's Dave Landry's The Week in Charts on my YouTube channel and previous Trading Simplified shows, I explained that in a lot of detail, including the day one rule, which I talked about last week. Anyway, there are the parameters down there. Entry 45.20, protective stop of 35.50, IPT, which stands for initial profit target, of 51.90. So entry is here, stop is down here, and IPT is up here. And this one is actually getting fairly close to triggering today, so we'll see how it shakes out. Here is another mystery chart. This stock is in a nice trend and it began to accelerate higher. And then it made this really nice TKO move. Not quite a Landry-like pullback, but a trend knockout, which is a pattern that I also trade. And there's plenty of other presentations that I've done just on that pattern. But basically what you're looking for is a sharp move higher, ideally a persistent one and an accelerating one. All of those things which you see here, followed by a knockout bar, a sharp, hard, wide range bar down. And that knocks out the fast money, those people without little staying power, those people with little staying power, and the Johnny come latelys, etc. It also sucks in some shorts, at least it does with higher price issues. But you can see, nice little TKO. Here are the parameters down below. Entry of 242, protective stop of 150, IPT of 334. So it looks something like this. We'll follow up on this one in upcoming presentations. Now, if you want to look at these, you can go to davelandry.com/archives. If you want to see them live, you can go to davelandry.com/trading service. The archives are 100% free. To see them live, there is a cost to that. But anyway, I would recommend, before you put any of your hard-earned money down, to go in and look at some of those archives to get an idea on how the service works, good, bad, and differently. You'll see everything there, warts and all. So let's shift gears and talk about Mind the Trade. We're going to continue our discussion on Jesse Livermore. Most of everything I'm covering comes straight from Reminiscence of a Stock Operator. I am getting a little color commentary from his biography. I am getting some color commentary from Jesse Livermore, World's Greatest Stock Trader, and that was by Richard Smitten. And it's a really good book. And then also, eventually, I'm going to pull a little bit from How to Trade in Stocks. But the one you should read first and foremost is Reminiscence. And this week we're still on Chapter 10. There's so much information in Chapter 10. It's almost like I feel like I want to read the entire chapter to you. So I would urge you to go out and read that on your own. And my apologies for a lot of reading it to you this week. Now, when we last left off, Livermore was arguing for trading commodities versus stock for their pure supply-demand relationship. And my argument was that you could treat stocks like a commodity because they are of sorts. And then further, the pricing of stocks like a commodity is based on supply and demand. Now, I do think that stocks actually have an advantage over commodities because the real money is in capturing a market inefficiency. So stocks that rally 50, 100%, or 200%, or even 1,000% or more, although that's not super common, it can happen and does occasionally happen. It's more likely to happen in a stock than it is in a commodity. If energies go up 1,000%, we're going to be in a lot of trouble really fast, for instance. Now, let's talk about Livermore on supply and demand. And then if I'd have read a little further last couple of weeks, he actually was saying that the same applies to stocks, that applies to commodities. Of course, the same things happen in all speculative markets. The message of the tape is the same. That will be perfectly plain to anyone who will take the trouble to think. He will find, if he asks himself questions and considers conditions, that the answers will supply themselves directly. But people never take the trouble to ask questions, leave alone seeking answers. The matter of tape reading is not so complicated as it appears. Of course, you need experience, but it's even more important to keep certain fundamentals in mind. To read the tape is not to have your fortune told. The tape does not tell you how much you will surely be worth next Thursday at 1:35 p.m. The object of reading the tape is to ascertain first how and next when to trade. That is, whether it's wiser to buy than to sell. It works exactly the same for stocks as cotton or wheat or corn or oats. So again, I was making the point for stocks over commodities, but then he goes on to say that the ticker for stocks is the same as the ticker for commodities. And you have to remember, you're trading traders and not markets. So you watch the market, that is, the course of prices as recorded by the tape, with one object to determine the direction, that is, the price tendency. Prices, we know, will move either up or down according to the resistance they encounter. So obviously you want to trade in the direction of the trend. Trade in the line of least resistance. For purposes of easy explanation, we will say that prices, like everything else, move along the line of least resistance. They will do whatever comes easiest. Therefore, they will go up if there is less resistance to an advance than to a decline, and vice versa. Nobody should be puzzled as to whether a market is a bull or a bear market after it fairly starts. The trend is evident to a man who has an open mind and reasonably clear sight. Okay. Recently, I was on Final Bar and I was talking about the pitfalls of trading. And Anais Nin once said, "We don't see things as they are, we see things as we are." So, channeling Anais Nin, we don't see markets as they are, we see them as we are. If you're getting ready to retire and the market is sliding, you might think, well, maybe it'll come back, and you hope that it comes back. And once you get in a position, like I said in the Final Bar, you feel like the market should move in your favor, and you might overlook what it's actually doing. So the trend is evident to a man who has an open mind and reasonably clear sight, for it is never wise for a speculator to fit his facts to his theories. So what he's saying there is, just because you think a market should go up doesn't mean it will. Again, you're trading traders and not markets, and you have no way of knowing how emotional these other players are. You don't even know how emotional you are. In fact, you can't make any decisions without emotions. That's neurology. They often say separate your emotions from trading. Well, you just can't do that. And the more you learn about neurology, not to digress, imagine that, the more you learn about neurology and trading psychology, the better off you are. Such a man who ought to know whether it's a bull or a bear market, and he knows whether to buy or sell. It is therefore at the very inception of the movement that a man needs to know whether to buy or sell. A man ought not to be led into trading by tokens. He should wait until the tape tells him the time is right. As I've admitted many times, I'm really good at following my core methodology. I put out a trading service every day, and I follow that trading service. I also do some ancillary trades that are related to the core methodology, and those setups come directly out of my Landry list, which I publish every day. Where I screw up a little bit, and sometimes a lot of bit, as I do get sucked in to the zigs and the zags, because I'm here all day in front of a half a dozen screens. It might be more than that. I haven't counted them lately. 1, 2, 3, 4, 5, 6. It's ridiculous. And one of them's a big screen TV. Anyway, all that watching of the markets can be kind of dangerous. The old stock market adage comes to mind: be as close to the market as you need to be and no closer. As a matter of fact, millions upon millions of dollars have been lost by men who bought stocks because they looked cheap or sold them because they looked dear. The speculator is not an investor. His object is not to secure a steady return on his money at a good rate of interest, but to profit by either a rise or fall in the price of whatever he may be speculating in. Therefore, the thing to determine is the speculative line of least resistance at the moment of trading, and what he should wait for is the moment when that line defines itself, because that is his signal to get busy. So you want to wait for the market to move. You don't want to try to, like he said, you don't want to bargain hunt or just get out of something simply because you think it's too high. Now, one more point here. He talks about the speculator not being an investor. An investor, before he buys something, he determines the value of the investment over the entire life of the investment. Let's say you want to buy a house as an investment, you figure out how much that house is going to be worth in the future and whether or not it's worth buying it now. When you buy a stock as a trader, your goal is to capture hopefully a short-term profit, but be willing to stick around just in case it turns into a longer-term profit. You are not trying to figure out whether or not this stock price is going to be much higher than it is 10 years from now or the life of the investment, so to speak. The public is so often whipsawed that one marvels at their persistence in not learning their lesson. Well, that's kind of that sort of dovetails back in to what I was saying earlier, is that people become impatient and they might have a little hyperactivity, again, guilty as charged. And what happens is when the real trends come along, like we just saw, I would love to tell you that we print money like I just showed you, but that only happens every so often. And in between, there's a lot of waiting. And in the meantime, people get worn down. And actually, in Livermore talks about this, these people are building a foundation for your next venture. So let everybody else fight it out, because mentally and monetarily, you're not going to be ready for when those next big trends come along. Not to pick on this gentleman, because hopefully he did stay with me. But obviously, he gave up the absolute worst possible time. Now, I don't know what else contributed to him giving up. Maybe he was in and out a little bit too much and trying to make something happen. I don't know. Or maybe I just bored him to death by telling him to sit on his hands. Thus, the intelligent trader who has patiently waited to determine this line will enlist the aid of fundamental trade conditions. Now, by fundamental trade conditions, he's talking about the conditions of the overall market, bull market, bear market, or sideways. And also the force of trading of that part of the community that happened to guess wrong and must now rectify mistakes. Such corrections tend to push prices along the line of least resistance. So what he's saying there is, let's say some shorts got a little eager on the stock. They might be getting squeezed out. There might be some FOMO happening from people who were trying to buy it at a bargain. And in general, a lot of your profits will come from the mistakes of other traders. Now, I was lucky early in my career to be hooked up with someone who's very old school and been around for a long time and knew how to read charts and taught me how to read charts. And he had a lot of sage advice for me. And one thing he often said was, surprises tend to happen in the direction of the trend. And what fascinates me is I'll learn something about trading today, and then I'll go read or reread a book from 100 years ago or even longer, and I'll find the same exact advice there. In fact, as I said before, I haven't done it lately, but sometimes on a weekend or something, let's say my wife goes to bed early or something, I'll get on eBay after I had a few beers or whatever, and I'll look for these old books on trading that are at least 100 years or older. And I found quite a few gems by doing that over the years. And a lot of these books I pull from in these presentations. And right here, I will say that although I do not give it as a mathematical certainty or as an axiom of speculation, and I guess I should have put the word tend up here because surprises tend to happen in the direction of the trend, my experience has been that accidents, that is, the unexpected or unforeseen, have always helped me in the market position whenever the latter has been based on my determination of the line of least resistance. Well, let me explain why this tends to happen. Because people get into a market, and a lot of these people who are getting in the market, they know something is likely to happen. They know that ahead of time. And they begin to push the market higher because they're buying these footprints on the charts. Obviously, you can see what they're doing. So there's a reason for the demand, not always, but a lot of times behind a stock And then conversely, there's a reason for supply. You'll see a stock drop, 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 and then all of a sudden it implodes. Some really horrible news comes out. Well, somebody knew that news long before you. So, as I often say, surprises tend to happen in the direction of the trend. That's why, or at least one of the reasons why I'm a big fan of trend trading. The trend has been established before the news is published. And in bull markets, bear items are ignored and bull news exaggerated and vice versa. Before the war broke out, the market was in a very weak condition. So people do look ahead. The stock market is a discounting mechanism. Somebody asked me recently, how can stocks be going up with everything going on in the world? Well, the stock market is looking ahead. And it's hard for people to wrap their head around that sometimes. They just think that some sort of logic should prevail. Everything seems rosy, so the stock market should be rosy. But that's not how it works. As I said quite a few times, my wife, especially when we lived out in the country where things broke quite often, there was a lot of stuff to break. She would say, all you got to do, and if you ask her, she'll say, I didn't use that bad English, but she did. We were out in the country. Anyway, she says, all you got to do is put your little wrench on that and cinch it up a little bit and stop that leak. Well, 3 hours later and 4 trips to the plumbing store and possibly a phone a friend or sometimes even call a plumber, the leak is fixed. But it's never that easy, but on the surface it seems like all you gotta do. And that's why trading psychology is so important when it comes to trading. On the surface, trading looks pretty easy, and many people have said that's precisely why it is so hard, because it looks so damn easy. It sounds very easy to say that all you have to do, and that's what my wife says, she says, is to watch the tape, establish your resistance points, and be ready to trade along the line of least resistance as soon as you have determined it. But in actual practice, a man has to guard against many things, and most of all, against himself. Amen. What's the old Pogo comic? We have met the enemy, and he is us. That is against human nature. That is the reason why I say that the man who is right always has 2 forces working in his favor. Basic conditions and then the men who are wrong. In a bull market, bear factors are ignored. That is human nature. And yet human beings profess astonishment at it. Why is the market going up? I don't know. Why is the market going down? I don't know. The trend has been established before the news is published, and in bull markets, bear items are ignored and bull news exaggerated and vice versa. Before the war broke out, the market was in a very weak condition. So again, surprises happen in the direction of the trend. And also, don't worry about the mood of the country or the mood of the politics or whatever else. Worry about the mood of the market. Is it making new highs? Is it generally going up? Are most stocks generally going up? Are most sectors generally going up? Understand what's happening in the general conditions and have that wind at your back, so to speak. Now, on letting the market come to you, like I just said, I waited for many months where we had a few positions triggering here and there, a few setups triggering here and there, but for the most part, we did absolutely nothing, bored my clients to tears, and then, bam, we began to knock it out of the park. Now, I don't want to brag, and people are like, Dave, you don't seem like you're that excited about it. It's like, well, I'm excited, but you know, these great trends come and go. Hopefully it'll last 10 years, and that'll be fantastic, but usually they don't always last that long, as you probably know. So he was bullish on cotton. It was hanging around 12 cents, running up and down within a moderate range. It was in one of those in-between places, and I could see it. I knew I really ought to wait, but I got to thinking that if I gave it a little push, it would go beyond the resistance point. So basically, he thought he could buy a little bit, kind of force the market higher to break out. It cost me about $200,000. I was done with it. It wasn't very long after that when it began to go up and never stopped till it got to a price that would have meant a killing for me. if I hadn't been in such a great hurry to start. So if you're trying to trade day in and day out and markets are choppy and not trending, when the trend comes along monetarily and mentally, you're not ready. Well, that's all my time for this week. I'm going to pick it up next week, and I'm going to talk a lot about the importance of waiting for entries and rehash some of the things he said about trading the line of least resistance. I would urge you to reread chapter 10 before next week. Again, here's my contact information, the slides, davelandry.com/stockcharts, and I'll also give you all three of my books in PDF format. If you need to reach me, davelandry.com/contact. And if you want to join me every week on Thursdays, unless it's the holiday week, davelandry.com/webinar. I want to thank everybody for watching, and may the trend be with you.